Hello, once again. Thanks for watching. Thanks for tuning in this week. Before I get into my many charts that show why we're just about at the point where the real estate market is going to crash, let me just talk about listing cancellations first. So I got a call, or my associate got a call from a potential client. They're currently under contract with one of the big franchise brokerages. And now this is not just against big franchises. Any brokerage can do this and do this, but they are no longer actively listed. Their listing is actually suspended because they're not getting along. Things aren't working out, whatever the case may be. The market's slow, of course, so it's going to be tough on both sides of that equation. But the listing goes on until November. The listing brokerage has suspended them. And they said, well, can we get a cancellation so I can go find another broker? And they said, well, if that broker gives us 25% referral fee, we will let you out of the listing contract. So they're holding this person ransom. It's not actively listed. It's suspended. No one can see it. But the seller didn't realize that there is no cancellation policy in this contract. The contract goes on until November, until the expiration date. And yeah, they have no way out. So they have to do what the broker says. It's on their terms. We'll cancel the listing, but you got to do this or that. And this is the way they can work. So my advice is make sure you know your cancellation policy, whether it's a listing or whether it's a buyer agency agreement, because they're very similar the way they're written these days. Let's take a quick look at them here. So both the listing contract and the buyer representation agreement, they have time frames. They have your name, your address, time frame, 3 months, 6 months, a year. It doesn't matter. They'll put it in the contract. Your responsibilities regarding commission, and this goes for both contracts. And here's the one important thing you should be looking for. This is right near the top of both of these contracts. And of course, it says it in buyer's terms on the other contract, but here it says the seller hereby gives the listing brokerage the exclusive and irrevocable right to act as the seller's agent. So irrevocable means you cannot revoke it. You sign the contract, you cannot revoke it unless you have a cancellation agreement or term set out. And where you set that out will be in Schedule A. Schedule A is for all types of things. How is the agent going to list the property? Who's paying for what? Sometimes the seller will pay for staging. Sometimes the buyer will pay for certain things too. So it's all spelled out in Schedule A. And yeah, you can add whatever you want in. But if you want to know the listing cancellation policy, this is where it should be written, and this is where you request. My policy is my people can cancel at any time. I say to everyone, sellers cancel anytime, buyers cancel anytime. I do not hold people under contract when they don't want to be under contract. I understand if some agents spend, a few $1,000s on some nice listing for a videographer and all the rest of this, and you want to cancel a week later, it's pretty annoying. I don't put myself in that situation. I have affordable and efficient ways to list homes so that I'm not subject to losing massive amounts of money if someone decides to cancel. And people need to cancel for all sorts of reasons, not just because they're not getting along with the agent. Things change in their life. Maybe their job opportunity doesn't work out. People die. People are born. There's all types of reasons, and you shouldn't be held victim or for ransom if something changes in your life. Anyway, just thought I'd point that out because it's a pretty important thing when you're signing contracts, and it doesn't really get talked about enough from what I see out there in the markets. Now let's get into some data. This data I'm going to compare to the US because we've kind of flip-flopped back and forth throughout the years. When we have a big downturn, the States doesn't, and when they do, we don't. And I kind of want to show you here, or I do want to show you how this looks. Now, first, I'm going to start with the yield curve. And for many of you, you know how the yield curve works when it inverts, meaning when you're getting paid longer on a 2-year treasury or Canadian bond than you are in a 10-year, it's inverted. You should be getting paid longer. There's more risk in the 10-year. Your money's tied up for longer. So looking at the yield curve, it inverted there a couple years ago. But as you look all the way on the right there, it is starting to come back up to zero, meaning it's going to uninvert. And looking back at history here, again, this is for the treasuries. The gray bars are all recessions. Now, looking at the last 3 recessions, excluding 2022, but it almost inverted there. You could see back to 2007, it uninverted. About 6 months later, recession happened. And that was a nice big recession there. Prior to that, year 2000, dot-com bubble, it inverted. It uninverted and recession happened right after. And of course, the end of the 80s into the early 90s, same thing. It inverted. And then when it uninverted, it came into a recession. So these are very highly linked to recessions. If you actually want to learn more about this, my good buddy Luke at Market Mania just did a video yesterday. It was kind of odd. I was watching. I was like, hey, I'm going to be talking about that. But I'm going to link his video in the description, and he gets into this in more detail. Now, here is the Canada 2-year compared to the 10-year bond, the spread here. Of course, we have been inverted since 2022. And look, we're heading back up. You can see there just on the right, it goes past, I think we're about 26, 27 basis points right now away. The states are closer. Looking at the states, they're like 15 basis points away from uninverting, and we're 26, 27. So we are creeping back up to that zero line when we will uninvert back to the way things should be when it comes to yield curves. And of course, recession hits right after that. So again, this is all part of the timeline. I talk about the timeline all the time. And yeah, this is not rocket science. This is just basic math and studying data. Just like I forecasted, don't need to be a rocket scientist to know prices drop in the summer, 95% probability of prices dropping. And of course, I looked at the data for July already, and they're down in the GTA and in the areas I have access to. So they will most likely be down across Canada. Again, 95% probability of that happening. This too, this has got to be up there on the probabilities. I haven't done the actual numbers on it, but it's probably 90 to 95% also. Another thing I talk about a lot on this channel is timelines. So I want to compare timelines with the US and with Canada and take us down that path to see where we are in comparison to the US. And of course, we're very closely related with our economies, but it's some interesting data here, and you'll see what I mean now. So here is the average price of US houses sold since 1965 or 1960. And you can see the great financial crisis there in 2010. Anyway, they go up and they go down. And of course, they're up big time, just like Canada. Next is TREB data. This is for the greater Golden Horseshoe area. So this is the GTA and all the areas surrounding it. This is the most populated area in Canada. This is the longest or the furthest back historical data I could get in Canada. The national data only goes back to 2005 or so I couldn't compare that. This is why I'm using this. I will introduce the national data back in once we get further on in the timeline. But as you can see, I'm using this data for now. Here is the national data, and you can see it's very similar. Let me overlay them just to show you what I mean so that I'm not cherry picking data. I'm using the best available data that I have. Here they are with an overlay. You can see very similar timelines. Of course, Toronto had a little bit higher increase in average prices, and they came from lowers. They went to higher, so a little bit more extreme. But again, I do reference back to the national data near the end of this. Now let's look at some of the major cycles. So we're starting with the United States data here for average prices on the chart I just showed you. So I'm just zoomed in here. As you can see, in the early 90s, we had a very similar downturn. Theirs only lasted 2 years, minus 6% for the average house price. So not a big downturn. They got off easy, right? Now remember, someone else got off easy in the 2008 financial crisis when it comes to real estate. Anyway, we'll get to that in a second. Now looking at Canada, this is the TREB data for the greater Golden Horseshoe area. Same time period from the late 80s, but it went on for 6 years, and we lost 31% as opposed to their 6% in the average sale price. So again, big difference, but let's move on the timeline here. Then they had to run up to the next financial crisis or next housing downturn. And the states, they went up 127%, and it took 15 years. So 142,000 from the average price to 322,000. These are US dollars. So 127% in 15 years. When you're looking at the greater Golden Horseshoe area, it took 13 years. Remember, we had a longer downturn in the early 90s. So it took 13 years, and we went up 108%. So 127% for the US, 108% for Canada. Now, in the US, they had a 20% downturn. It took 4 years in the great financial crisis there from 08 to 2011, or 07 to 2011, I should say. So they went from $322,000 to $259,000 for their average sale price. And again, 4 years, 20% drop. It seemed like a lot more, but these are the numbers. It was only 20%. I heard 33% previously. And I think when you're looking at median in certain areas, it was obviously up to 33%, but they had a big housing crisis. Some areas lost like 50%. So this is a national average. Now looking at the Canadian data, our downturn was like a year. So theirs was 4 years. We were a year, only 12% down. So about half as much decline as the US from 395 to 347. Again, this is the greater Golden Horseshoe area. When we're looking at the national, now I can introduce the national numbers back in because I have the timeline to do it on. We were down 14% nationally. So again, got off easy compared to the States. They were 20%. It was actually more in a lot of places, but regardless, not as intense as the US. Now we enter our current time frame. In the States, they have run up after the great financial crisis, after they lost that 20%, they went from 259,000 for their average house price to 501,000. Still pretty aggressive. Now their wages are a lot higher than ours, especially in US dollars, but they went up 93% in 13 years. Looking at Canada, or looking at the greater Golden Horseshoe area first, we increased 233% in 15 years. That's more than double. That's like 2.5 times with 2 extra years involved, 2.5 times almost what the US did. They were 93%, remember. Now looking at the Canadian national numbers, we are up 153% in 15 years, as opposed again to the States at 93% in 13 years. So we've had a lot bigger run up, and we're going to have a lot bigger downfall too. And again, we've alternated. It was us in the early 90s, then it was the States in 08. Guess whose turn it is now? Of course, the one who had the bigger run-ups. More to gain, more to lose. Now expanding out just to look at the time frame on these cycles. Now the States has a picture perfect 17-year cycle here. A lot of people predict real estate goes in 17-year cycles. Well, look, they have 2 years and 15 years on the run-up, 17 years. And then after the great financial crisis, they had a 4-year downturn and a 13-year run, which puts them perfect timing for a housing downturn right now. Canada's numbers aren't as spot on, but we had a 6-year bear market followed by a 13-year bull market, then only a 1-year downturn and a 15-year bull market, which again puts us right in that time frame to see a housing downturn. If it's not this year, it's going to be next year. Now, these next two charts I posted on X this week. These are pretty important because these show where we are in the market. And I'm comparing two metrics. I'm comparing, first of all, the Bank of Canada rate and the unemployment rate, and next, the Bank of Canada rate and the average price. So let's check these out here. Again, using the data that's available. This is from the freehold data from the Toronto Real Estate Board back in the 80s. Our cycle is now more comparable to the 80s. You can't compare it to 2008, which a lot of people do. They say, well, what about 2008? That was our last housing bubble. It wasn't a housing bubble in Canada because it didn't pop like a housing bubble. Our housing bubble is now. So anyway, this is where we are. The blue line is the Bank of Canada rate. You can see a couple of cuts and look at the unemployment rate starting to rise just like it is in Canada right now. And I've made a chart exactly where we are now. You can see the Bank of Canada has just started dropping their rates. That's 2 rate cuts on that chart. And the unemployment rate is starting to rise. And you're going to see it rise a lot quicker. Next is the average freehold price. And again, this is the data from TREB. I don't have national data to go back this far. I wish I did. But again, one of the biggest metro or the biggest metropolitan area in Canada. Here we are. Bank of Canada, after they cut their rates in the early 90s, a couple of rate cuts. Look at the house prices. They declined along with the rates. That's what people don't understand. They're starting to understand it now. I said this since last year, maybe the year before. When they start cutting, house prices will start falling. Things don't get more affordable and everyone jumps in the market. And we've seen that now. It's been 2 rate cuts and sales are at their all-time low right now in Canada. And here's the same data for today, except I'm using the national average price because we obviously have that available, and 2 rate cuts, and the average price is not doing so well. We've actually made new lows for the last 2 years. So we are seeing lower lows, which would establish a trend of falling prices. Once July's data in there, it's not in here yet. The last data was June. July's data is going to be a nice leg down, and we're going to start seeing prices fall. Just as a reminder, here are some other major cycles in the world that people have talked about. You've probably heard others talking about them online or on X or wherever you do. Here is the Japanese real estate market. The Central Bank of Japan, they started cutting rates in the 90s. And look, just started cutting and their prices dropped. And they dropped for a long time, 15, 20 years. It was ongoing. Theirs was one of the biggest real estate busts in known history. Here are the Irish house prices and the European Central Bank rate. Of course, they started cutting after the States there in 2009 with the world economic crisis. And look at the house prices in black. They dropped with them. Actually, they were dropping before, but they kept dropping right through those rate cuts. And lastly, here's the US again, but this is from the last time, 2006 to 2012. And you can see there the red line, they started cutting rates. And look at the prices. They dropped like a rock right with them, and they didn't rebound until after 2012. So I'm pretty sure this data firmly backs up where we are in this cycle right now. Prices are not going to be going up like many people have told you, and I've said this many times on these videos. Prices just won't go up. It goes against the whole cycle. The cycle, they're cutting rates, and many people say this, and many people talk about this nowadays. They're cutting rates because they need to, because the economy is not doing well, unemployment's going up, GDP is dropping, and whatever else is going to happen with these cycles. Anyway, let me know what you think in the comments, and I'll see you next time.